to do about that buzzing?
Sorry.
No, I'm not muted. Okay, cool. Let me just do a quick check. Everything's working. We can get going. It might be the last. No, it's fine. No stress. Cool. Everyone, welcome. Nice to have you here. We're gonna go through small business tax. I just want to run through this with you guys. We have actually covered it previously. So I want to go into a bit more detail. We've just passed the halfway point of the year in terms of tax year, which is end of August, and we're rapidly approaching end of February, which is when the next tax time is. So we want to just cover small business corporation tax. We find most of our clients fit into this category. Okay, so it's quite important to not just understand the tax part of it, but then also what other benefits there are. But as we know, SARS doesn't like to give away anything. There's nothing for a mahala with SARS, like zip. So we want to just run through. There are some things that work, but then, yeah, we'll go through from there. We don't need to know about this guy, so that's fine. So small business tax, do you qualify? We look at some of the incentives, or what SARS calls incentives. We found there's only really one or two that are really true incentives. We actually get more back than what you pay in. So we want to go through that. These talks are fairly casual. So if you think of anything, got a question, Ken will read out the online ones. If you guys have an actual question here, just ask, just stop me, question, need to know something. Okay. So the talk won't be very, very technical, but we're going to use the proper language, the proper sort of terminology in terms of SARS. So when somebody asks you the question or you want to find out further information, and you've got the right stuff. Okay. There you go. Is your business viewed as a small business corporation? Just dive straight into it. Okay, so these are where we're at. First of all, it's the size of your company. Is your turnover less than 20 million a year? Okay, that's the first thing you think of. 20 million. Most SMEs fall into that space. And people, I know when you think of that number, 20 million, that's not a small business. I'll be happy with that. But that's really on the edge of micro enterprise. Small business is really sort of 50 million if you look at normal annual, like worldwide stats. 50 million, 100 million will then be medium, 500 million large. Okay, so we're really in the SME space, small, medium, micro enterprises. So 20 million, and then obviously your shareholders, the people who own the shares, your actual physical people. On occasion, if it's a CC, you can get away with the trust if the beneficiaries of the trust are actual people, not another corporation or another entity, actual people. So all the shareholders must be people, and this is the only business they must own. They can't own multiple businesses. The reason behind that, we have touched on previously, is that SARS doesn't want you to take a 50 million rand business, break it up into three, and now I've got three small businesses, all of them getting a tax break. They're like, that doesn't how it's going to work. So it's got to be a single entity that you own. That's it. And they don't count things like shares on the JSE, or if you've got other investment products. It's only if you've invested into another actual registered entity. Okay, cool. Turnover, does 20% from investment income. So your business is doing well, you're investing money on the JSE or into other companies, because remember your actual company can own other companies. So as long as the shareholders aren't actual companies, but your business can own other companies, 100%. You can still be a small business. So now those investments are generating revenue. Maybe they're paying you dividends, or they're paying you a royalty, or they're paying you something. So 20% is not investment income. So then it's fine. Okay, I've lost you. Yeah, so what happens is you got to look at the entity as on its own. So you can own like how they define it, you've got a registered entity, it's got its own name, registration number. If that entity, it can only be owned by individuals to be a small business corporation. It can, however, own other companies. So what we find is, let's use the example of what I said earlier. SARS doesn't want you to take a 50 million rand company and split it into three. And now all three entities now, you think, oh, they're all small business. What you can do is register two separate companies. Your small business owns those two companies. No, not the individual. And then what happens is your revenue will drop down. So the holding company earning maybe say 15 million and the two subsidiaries making up the actual difference. The holding company is still a small business corporation, providing it's owned by individuals, people, actual people. However, in that example, just to finish where I might have lost you, is that now think of those two subsidiaries. If the money coming back to head office, the investment income is greater than 20% of the actual turnover, you're no longer a small business. So just look at how that works out. So there's a little bit of tax planning in there. We have done in the past where companies are larger than 50 million or people own multiple companies. So then what you'll do is you'll put the shares with your children, your spouse. That way they're separate individuals owning an entity. Therefore, all of the entities actually qualify as small business corporations. Okay, so it just takes a little bit of planning. Cool. And then less than 20% of your income must not be personal services. So young architect friend here, personal services is something you do yourself. Like we do it in terms of accounting and stuff like that. So if I'm doing tax advisory, 20% of the income can't just be what I do. We would have other people inside the company earning income. Okay. So that's where you do that split. So that's the basics. If you tick all those boxes, you're a small business corporation. Okay. So there's not a lot of things that you got to think about. You know, it's there's not like an endless list. These are them. Fairly simple, very easy to actually structure, and it probably covers about 80% of the companies you'll find in SA. So it's nice and broad, very, very helpful. Yeah, personal is if you like a personal services company, like accounting or architecture, where the owner of the firm is doing the work, is actually responsible for the income, providing you're employing three people that are not family, and or three or more that are not family, and they're also generating income. So like you can't go and say, no, I've hired a cleaner, I've got a gardener, I've got the driver. They're not earning income, so you won't actually qualify. So there'll be people that are actually earning an income. But they're not on the personal services side. Even if the owner now, their portion is more than 20% of the income, then you don't actually qualify. Yeah, so it maybe teaches the owner to like throttle back on the work, hire more people. I think that's what they're after, to get more jobs. So we sit further back. So Ken, KG, remember, I must sit further back, not do less work, and then we qualify less work, eh? So Ed, make sure we issue and recording this, eh? Perfect. Anything else from there? Questions on that? Yes. You can't own multiple companies. However, your one business can be the owner of the other companies. So, for example, if you own 4 or 5 little businesses, because often we think, well, how the thought process would normally happen when you register a company. I've got a transport company, and now I'm making some good money, so instead of paying somebody else for fuel, I open a fuel station, and I register that as a separate company. Now I've got 2 companies. I'm then like, and in that example, I won't be a small business. However, if my transport company owns the fuel company, I'm good. You see, so the transport company will be the small business, and the fuel company won't be. So you just work out your taxes, where you're going to put your expenses. You hire people like us, and we'll structure it nicely on that. Cool. Questions anyway? Online? Can anyone? No questions? Fabulous, fabulous. So is it worth it? So this is the basics around it. So if you're not a small business corporation, the minute you make 91,000 rand profit, so 0 to 91,000, that's your tax. Isn't a lot of money? You think, okay, it's, but then, if you're a small business, 0. You're not paying any tax. So the saving is quite good now. 25,000 rand saving. The next threshold they work through, instead of paying 98,000 rand tax, you only pay 19,000. Okay, and this goes on until above 550,000. So what a lot of people don't realize is that the majority of small and medium enterprises don't make a profit. Like Uber doesn't make a profit. So we're all in the same boat as Uber. They're big. So that is quite a substantial number, 550,000 in profit. That's after all your expenses are being paid. You've paid everything. You paid your salaries, you've done everything, you've got 550,000 in profit. Okay, so, but most small and medium enterprises, especially in this sphere, are not even getting there. It's mostly a loss, or you may be breaking even, probably in this space. And where the 91,000 sort of comes in, that's sort of in line with your personal income. So if you're earning less than 91,000 rand a year, working at a job, you're generally not paying pay as you earn. You see, so that's where they're equating it to a person. All right, cool. So as you can see, the savings over the year, a little bit over 90,000 rand if you're a small and medium enterprise. That's just the income tax saving. There are other savings which we'll go through, and what those savings do is they lower your actual profit. And there's quite a few of them. So, but just on tax, income tax alone, 90,000 rand, what can you do with that a year? You can pay yourself extra 90,000 rand, happy days. Buy a small vehicle, I think a Datsun Go or one of those Renault Quids are about 90,000. So there's additional income that you would have paid SARS that you now have available to invest in something. Generally, the investment should be yourself or your company. And then it goes back into the first bit. That's what then helps you grow your actual company. But that's the goal. Take the money and grow your actual company. Okay. Cool. So, besides income tax, we'll go into those now. So things like and depreciation. If we use the example of the vehicle, so you buy that vehicle for 90,000 rand. Maybe it's a little LDV, transport vehicle. In the first year, you can write off half of its value. So 45,000 rand comes straight off your tax in terms of like and depreciation. So how do you explain it? And depreciation is not a real expense. So it's not real money you're paying out of your actual company. So if you take the assets, you sort of, like it's wear and tear, like SARS allowing you to write off the asset. and it comes on your income statement, and it lowers your actual profits. And the benefits with that is obviously it's not cash. It's not a cash expense that's going out of your company. So that way, the more things you can write off at a faster rate, the lower your actual profit, smaller tax. So you see, so if you can get the cycle working quite well, and I've used the example before of a client who was into juice, selling fresh juice and stuff like that, and he bought himself like a bottling plant. Cost about a million rand of plant, but he was only ever averaging about 400,000 or 500,000 rand profit a year. So he was in the small business frame, getting his 90,000 rand. He bought this plant. Now he could write for 500,000 rand, 50% in the first year. What's that doing to his profit of 500,000 that he was normally having? Zero profit, which means zero tax. So what he did with it, he was like, damn, I'm buying another machine. But obviously now the second year, he's doing well now. He's got two lines going. Now his profit's closer to like 800,000. But now because he's got a new line for another, like another bar, right off another 500,000, and then 30% of the previous one, so another 300,000. So 800,000 rand off his actual profit. So he didn't pay tax the second year. You see, so this is where it's going. It's not an expense that he's paying out of his company, but yes, it actually goes on your income statement, lowers your taxes. And that's way more, like, in terms of actually expanding your company, it's way more beneficial than saving 90 grand. You know, 90 grand is the small stuff. It's the big stuff. Keys, plant. If you're working in IT, all your laptops, you write up the whole thing in that year. You don't have to like spread it out over multiple years. So again, it's a good tax planning tool. You might find that you've got you're not making a very large profit this year, but you know you'll make a large profit next year. So write all the things off, get a nice big loss with SARS. Next year when you make your profit, you don't pay tax. Okay, so it's part of your cash flow planning around that. Obviously, we'll go through this. So small business corporations. So SARS doesn't like a thing called arbitrage. You mustn't be able to get a benefit of doing one thing or the other. They want, whatever the tax is, it must be equal. You can't get a benefit out of it. So if you're a normal company, your tax should be the same as any other company. But small business corporations have a little loophole, and it's because of the sort of gradated tax rate. That's sort of what we went through earlier. Let me just go back. So on this. So because you've got this gradated tax, it gives you an opportunity in terms of structuring your pay as the owner of the company. And it's, you know, one of the few benefits that you have around that. And what we've done is, obviously, if you look at the tax tables, the caps out is 1.7 bar in terms of income. So if you take the pay as you earn, so if you're just looking at now, your actual company's made 1.7 bar per profit in the year, and now you're thinking, what am I doing? You haven't paid yourself yet. So it's profit 1.7 bar. What am I doing with it? If I took all of it as my pay, that's your pay as you earn. 600,000 rand that you're paying SARS. But then the company's paying no tax because there won't be a profit. You've taken all of it out as pay. Now if you mix it up, small business, you mix it up with salary, the company tax, that type of structure. So you break it down accordingly. 388,000 pay as you earn, 58 small business tax, and then your dividends tax, bringing you your normal actual breakdown. The dividends tax obviously is smaller because you're paying more, like you're actually paying in terms of total tax of a company. So it does give you an advantage as an entrepreneur. And this is obviously at the maximum scale. But you have these opportunities at the end of each year is to look at the mix of your pay, what the company's going to pay in terms of income tax, and what like that. And then you can structure accordingly. And as you can see, being a small business corporation, the saving is definitely the best there. So that allows you to, so just always try to keep yourself as a small business corporation. Ultimately, when you're making big bucks, like with the hen, you actually don't care because so what? It's like a rounding error in your life. Okay. Questions on this so far? I know this is like higher grade tax comp, but the idea was to just illustrate why you want to be a small business. Why it makes sense. Exactly what, yeah, so it's exactly what you're saying. So what SARS is doing is they allowing you to reschedule how your expenses impact your income tax. We do have two examples which we're going to go through, which are a true benefit. Because most of these are not a true benefit because you've already incurred the expense. If I've spent a bar on a machine, I've spent the money. All SARS is allowing me to do is write it off faster, which means I pay less tax in the short term, but guess what's happening? After my 3 years, um, they'll actually take their tax after that. You see, so you actually kick the actual tax can down the road. You're still going to pay. Make no mistake. SARS never, like, their hands inside your pocket all the time. So, but there are two that will go through that is a saving. You get more back than what you spent. And that's key. So the trick is to use all of these at the same time. So what you do is you move the tax can down the road, then you implement the savings that are more savings, so more than what you spend, and that then allows you to pay less tax. Because if you look at how tax goes every year, they normally move the tax thresholds, move the tax tables. So if you keep kicking the can down the road, eventually pay as you earn on that bar is going to be a lot smaller in 6 years' time than it's now. Because they move the tables all the time. So the savings get more and more and more over time. So the goal with tax planning is how far can you kick the ball down the road and keep it going. Okay. So this is one of the incentives that do work. Employment tax incentives. And I think a lot of small and medium enterprises, well, I don't think, I know for a fact, because we do the books, a lot of small and medium enterprises don't use this. Because often as a small company owner, you're always afraid of hiring that first person because how am I going to pay them? The biggest stress is always how am I going to pay their bill? We're never thinking of that person is going to free me up so I can make real money. They can do the admin or do something so I can make the real money, which more than pays them. You know, for me to hire a junior accountant for 500 Rand an hour saves me enough that I can use those hours to charge 2,000 Rand an hour. My time's worth a lot more. You see, that's the thinking to it. And ETR is one of those things where when you hire somebody under ETR as a small business, it does benefit your pay as you earn. You actually get money back. So that's one of the real benefits. So yeah, we just dive into it a bit more. I'm not going to read all the slides are quite in detail, but I don't want to read through them. So obviously it actually drops your cost of hiring. You end up getting money back. So that's the goal. You want to make sure that the person you're hiring is always benefiting. It's one of the biggest costs for small and medium enterprises, and we see it a lot, is that when you hire somebody, you think, okay, their salary is $5,000, and you put inside your little budget, $5,000 salary, and then you forget you need a desk, you need airtime, maybe you need a bigger office, so suddenly it's $10,000. Now there's $5,000 you weren't expecting, and they're only going to start making you money in 3 months because you're going to train them. So in return, you're not making money because you're spending your time training them. So it might be 50,000 over the 3 months. A lot of people don't think that. So, and it's important. It's important to understand these things, but it mustn't scare you. But what ETO does is you get a payment plan structure over 6 months. Now you're actually good with SARS. Okay. So have a look at the different amounts we'll go through. So who the people would be. So you can't work for government. Okay, they already take enough. I think so it's good that they're not part of the plan. If the Minister of Finance actually decides, so there are certain sectors that they do throw out, but for most of the SMEs, it's not really anything we're going to think about. So when can you claim the incentive? So this is what your staff have to look like. That's the mix. So Africans, 18 to 29. So like, I can't take my housekeeper and say I'm claiming ETR. It's off. You see, so SARS has been very clever in the sense this is geared at small business people. Other a month. So as with everything, you can game the system, understand the rules. So you might find, for example, how much detail should I go? Okay, I won't mention the people, but you might, for example, find out that you run a business, and let's say it's a shop, but you're only open for 10 hours. Now, under normal basic of conditions of Employment Act, you can get yourself to work the extra hours every day, to make up the extra time. You pay them a little bit more, and that's fine. But now you think you want to open a second store, but you want to keep your best staff from the first store. So you split them, and then you hire 4 new staff, and they only work 5 hours. They obviously earn a lot less than the staff that work the 10 hours, the more senior staff, and as a result is all 4 of them get the ETR, providing they fit the actual criteria. So instead of hiring somebody for 10,000, I've got 2 staff working 5 hours each and they're earning 5,000 to get your ETR. So that's why, again, look at all the things as a whole. You know, don't try to build your business around ETR only. Look at your small business savings. So if you think about the tax, I'm going to loop it back to the small business tax, the 90,000 in saving. Take the tax saving from 90,000. Look at the use you can employ with 90,000 over the course of a year. Now look at the ETR saving you're going to get. You probably made another 100,000 in savings in the course of the year from SARS. So like you try and loop all these incentives into each other. That's where it works best. Because the thing we find is, especially with owners of the company, they're the ones who are normally paying the highest pay as you earn. Or staff who are outside the loop of the 6,000. They're the ones that are paying the pay as you earn. So if you're employing the youth through the ETR program, what ends up happening is your pay as you earn bill is a heck of a lot smaller. So if you want to do an expansion of your business, you want to test the marketing theory, you want to just trial something, it's a lot cheaper and you get a tax break. So this is one of the proper savings where you actually get money back more than what you're spending. No, we don't. Well, so unfortunately, the small business owners end up working for SARS by filling in all these forms. Technically, we shouldn't. They should pay us. But that's another court case that's been dragging on. The thing is, we agents, the way the law is structured, we are then agents for SARS. So it's not our expense. So we were withholding pay as you earn from staff, and we paying it over to SARS. So we're working for free, and that's illegal under the Basic Conditions of Employment Act. That's slavery. So, but they do that. I mean, that's one of the things. But that's the same thing. So the thing is, it's not our expense. You see. However, the actual company gets a benefit that they've got to pay over less pay as you earn to SARS. So they've withheld the pay as you earn, and invariably the pay as you earn is from the founders or owners of the company. They tend to be the highest earners. And if you look around, I mean, when you growing your company, you're generally paying two people the most amount of money. First of all, the person who, if you've got a salesperson, that salesperson should earn, especially if they're closing, they should be earning way more than anyone else. They're bringing the work in. And then the founder who coordinates everything, funds everything, takes the risk. So those types of people earn the most money. So now when you get the ETL and you want to expand, the tax saving is the companies for taking the risk, not the employees, unfortunately, that you're holding the pay as you earn from. You see, so that's kind of weird. The employee gets their money back at the end of the tax year. You know, it's like if you do their personal tax, they'll get the refund back at the end of the tax year. Yeah, I'm not sure how that ties in with the ETR, but, you know, on that. The thing is, so what happens is the pay as you earn on your EMP 201 is still exactly the same pay as you earn. So we run a payroll, we all work at a company, we run our payroll, and our pay as you earn for the month is 40,000 rand. So on your EMP 201 that you submit, you got the pay as you earn, UIF, STL, all the calculations through, but now half of you, as I can see, are under 29. Definitely you and me out of the equation. But we can fit it. Now, if we all fit into that actual group criteria, SARS then says, how many of your staff? And we tick all the boxes. And now we only have to pay over 30,000. But on the RP5 for the staff, it's still the full pay as you earn because they get it back at the end of the year when they do their taxes. The company gets a benefit saying, thank you for employing all these youth. Here's a refund. And you get your refund monthly. You don't get it at the end of the year like your RP5 if you're doing personal taxes. So similar thing. That makes sense. Okay? Anyone who works is employed by the company, and director is an employee of the company. So we often forget we wear three hats as a company owner. You know, we're the shareholder who's on risk, we're the and director who gets sued because we're the board, we run the company, and we're the employee who's employed in the. So just make sure so we do fit under. I mean, a lot of people structured. There's good tax structures. I'm not going to get into that. But if you're an employee, which and director is, they've got to be a payroll. They've got to be on the payroll. Yeah. Okay. Cool. So obviously it's just going into the details that I just explained now in the EMP 501, how you would claim it back. And it's generally automated. So as far as I'm not going to give you a refund, you just pay less when you make your payment on the EMP, EMP 201. Okay. No refunds. See. Although there is an exception, they do. I'm not going to dig too much. One of the things to remember is obviously it's for 2 years. For each employee that you bring on, it's for 2 years. So they halve the benefit in the second year and then it falls off. So the assumption would be that you've now hired a bunch of employees to expand or to test a thesis, whatever. Is it working? Because after 2 years, it must be working, hopefully. Now they're permanent staff. So, no, interns are slightly different, but they would fall under the ETR now. But normally interns are, yeah, it's pretty similar. You want to get youth in, you want to blood them, it's like, hey, I'm looking for youth to start at the company. You must have 5 years experience. Like, no, no, no. You want to avoid that nonsense because I mean, like, what's the point? The idea is to get people with low or no skills and obviously improve their actual opportunities. So even if they don't stay with you after the 2 years, maybe you don't need them because that new store didn't take up as well as you thought, or what you were testing at the same time for ETR, because who gets the claim? You can't both get the ETR, you see. Yeah. And generally, you have to pay the initial threshold. Okay, so what we did notice, which was quite interesting, and SARS has been very quiet about it, and so is the Department of Labour. The numbers, let me just move on to the next slide. The numbers are quite interesting. What is the minimum wage? Definitely higher than there. 3.7 something, is it? 3, and that stood out, and I was like, wow, they haven't made it clear. And how we've interpreted it is that it's obviously people not working a full 40 hours. The example we used earlier about having a store split the staff, let them work 5 hours each, and that way each staff member gets the full benefit. So maybe you're launching a product, so you've got a whole bunch of brand activation agents, and they're all working a week a month to get the brand rolled out. So under the law, they'll still be employees because they're working more than 21 hours a month, but they'll be under that national threshold. You can claim ETR on all of them. Okay. So it's very much geared around the minimum wage. So as I was saying earlier, that's a breakdown. Obviously, first month, and then second month is essentially half the claim. Because generally, the people are generally earning more. They've got a salary increase moving into the next year. No, that's the wrong way to see it. ETR thrives on skills transfer. No, I'm not gonna, it's a lot cheaper to sit at home and do nothing. You know what it's actually doing, now that you're saying that? What it's actually doing in my head is that, remember trade schools? Someone, so I'd work with them, and as an artisan, as an intern, you often earn a lot that you're in a small sort of like stipend, really, because you are learning my skills. And I think that's what this is actually doing. It's actually that audit, when you look at all the features, they don't work. I mean, where's the skill transfer from all that in the actual features? Hasn't worked. So I think this is what it's doing. Sure. So here's another incentive. This is not really self-called an incentive, but again, it's like we were talking about earlier, is you've already spent the money. They're just allowing you to actually write it off faster. Definitely a good one to look at. Solar with Eskom, load shedding, this substation that just burnt down in Durban yesterday and last night. So solar doesn't have to be a 150,000 rand rooftop batteries, everything. It can be a simple grid with light bulbs. It might be a 2,000 or 3,000 rand operation to keep your small business running from home or whatever. You write it off in the year that you buy it. So SARS allows you to do it. So if you work from home, put it in your house. Yes, you get the benefit of it, but you can write it off for tax in your company. Okay. Again, it's not a real incentive. They're just letting you expense it faster. That's really what they're doing. What's not on here, I didn't see it. No, I'll just go through. I mean, as I said, they're just accelerating the actual and depreciation. It's coming into play for a lot of large corporates where they're obviously getting a massive benefit. I mean, if the guys who own the mall up the road, in fact, even the stadium, the shops decide to put solar on all the roofs, spend 6 bar, which is probably what it'll cost to set up this place, they can write it off immediately in the year that they get it, which would be a massive saving. So that's all it's doing. Yeah, obviously they want to accelerate people off the grid, which seems silly. But you get these slides. But the other incentive that I didn't put on here that I wanted to touch on was R&D. Now, it's not a research and development incentive. So especially for entrepreneurs who are coming up with something new or something innovative. So if we use the solar, for example, maybe you come up with a more innovative solar product that generates more electricity per sunlight hours or something like that. And it might be the chemical composition change of the battery or whatever. So there's some research going into what you do. If you register it, you can register that R&D, that research. And now you get back 150% of your expense. It cost you 100,000 to develop the tech. When you now expense it, you can expense 150,000 rand. So that's a real incentive. You know, and it can be anything. So it could be a different braking system on a truck. You see that truck that just plied into the people up the road, something like that. So anything that's an improvement on a product, it could be a really cool tech algorithm, it could be a nice app that's built, anything that's innovative and new research. So obviously we see what doctors are doing, like medication. They're coming up with new pills and stuff like that. But also, in fact, in the architectural field, they come up with a lot of this new, like concrete and new types of and material that doesn't burn. That R&D, if you do anything innovative, it could even be fashion. Maybe you've come up with a new glue. Instead of stitching, you can just glue your clothes. That's it. That's anything along those lines. You can claim the 150% of your expense. So of the two of the ones we've been through here, the two that are real incentives, ETR and R&D. The rest are just accelerated, like, and depreciation, really. So also letting you expense to be spent faster. But the idea is what I was saying earlier. Look at them all in sequence. Look at your business. Look at the incentives. How do I apply those incentives to kick the can down the road? That's what you want to be doing. Kicking the tax can as far down the road as you can. Because it's always going to be cheaper. Governments are always lowering taxes to attract investment. They're creating new incentives. So the further down the road it goes, just think about it. So now, you guys are fairly young. You see, you're all too young. With the change from the old National Party government across to the government of national unity and then the ANC, I think the company tax was over 40%. 27 now. So imagine if you're kicking the tax can down the road for 24 years. That 400,000 rand tax you would have paid on your million rand profit is only 270,000 rand now. That's a good saving. So just figure out in your company with your structure where you want, but the first thing is, where do you want to take your business? Then you build the tax plan around that. Okay, with these incentives. And then, okay, you want to kick the tax can down the road as long as you can. Okay. Yeah, I'm not going to, let's just more talk about the stuff. Just so you know, government's not out to get you. I know it feels like it. They're most certainly not really helping, but they know they need us. They do make it difficult for us, but they know they need us as small business owners. So taxes do come down. Compliance is getting easier. I know we don't feel like it at the moment with SARS, but a lot of the e-filing and online processes are faster. So it's still badly executed, but it's definitely faster. So they are moving the right way. And there are a lot of organizations that are looking at small business taxes. We're working with some of them to push the government to adopt SME, proper SME taxes, SME visas, and things like that. So yeah, just to, they're not. So maybe it's going to change it. Cool. Questions on what we've actually covered? Anything online? Are they all asleep online? Am I muted for online? They haven't heard a word I said. I'm surprised Mark hasn't asked me a question. Yes. So structuring your tax plan for a small business. So the first step would be look at what you want to do with your company. So like just, and it doesn't have to be an exact time, just draw out a rough sort of 5-year plan. I know people say, 5-year plan is, but just like a rough guide. You know, that in your head you've got a picture, because the actual, and don't worry about the day-to-day sort of, how it's going to work day-to-day. Just in general terms, where you want to take your business, because we know we're going to go from Durban, Joburg, but we might not take the N3. Because there's different routes, but we're going to eventually get to Joburg. And it might be a week, it might be 3 days, depending how we're going to do it. So do the general plan, general idea, and then you look at, are you a small business corporation to start with? Tick all those little boxes so now you already know you're getting income tax saving and you're getting accelerated write-downs. Then you look at the staff you need to execute that goal. How many of them would be part of your ETR plan? How many of them would not be? What is that going to cost you in terms of pay as you earn? Because that's something you're going to be having to generate it. Maybe it's better to actually than soda instead of a generator because petrol's going up. So just think of those. So just you sort of walk it through like that. Are you coming up with innovative products? Is there an R&D opportunity? And one of the sad things with R&D, unfortunately, is it takes them about a year, sometimes longer, to process your application. And you can't apply retroactively. So I'm going to put an application in saying, this is what I'm going to do. And that way, in the past, they wanted you to actually, they wanted to approve it before you start. But because they're so slow, you might wait 18 months to approve your R&D. And I think you're building an app or you're writing an algorithm for Facebook or something. And now they take 18 months to approve your R&D plan. The world's changed in 18 months. So what they did was they actually, when your application was in, you can start keeping a track of all your expenses. And when they approved it, you got your R&D plan. So just think about where your business is, those type of things. And then once obviously these talks help. Because they've helped framing like your actual thing. But then once you've got that, spend an hour or two with somebody who understands tax, understands your business. And it might cost you 2,000 or 3,000 rand, but it's going to be money well spent. Because to figure it out when you're making a lot more money and realize, I've just cost me 100,000 rand in tax. YouTube's amazing. We've got obviously our actual, all these things get them and recorded, they go onto YouTube, you can listen to it again on our website. But that's the basics of the outline in terms of coming up with a tax plan. Okay, cool. Anything else? Can't be that good. Come on. Come on. Come on. One more. There must be one more. I'm disappointed there's no one online. Okay, cool. Guys, thank you very much. We really appreciate your time. If you've got any questions, I say this every time, maybe you're feeling awkward to ask, fire us an email. Okay. Our email address is on our website. Send an email. This is what I would have liked to have asked you. Ask us. We'll phone you. Have a chat with you. Okay. Perfect. Thank you, everyone. Appreciate it. Thanks, guys online. Have a great day. Yeah. Ed, wake up the people who are sleeping. They must go now. Okay. Ciao.